Welcome to Upticks. I'm Jake Falcon. I'm the founder of Falcon Wealth Advisors and your host for Upticks. Today is our 51st episode. We're doing a mid-year market update with Jesse Wilkins. Okay, Jesse, welcome back to the show. It's been a while since we've had you on here. I know you've been busy making the stock market go up.
Yeah, that's been my entire job.
So thank you for that. We've subbed out Corey again this week, but I'm planning on bringing him back next week maybe. So Corey's off working in our office. But for today's show, we're coming up as of the publication of this show will be through June 30. And I wanted to give our listeners and our audience kind of a recap of where we've been and where we think we're headed. So why don't we talk about that first? So why don't you kind of give just a big macro update of what's happened in the stock market for 2019 and the first half of the year?
So I think coming into the first of the year, not a lot of people would expect us to be where we are now when we started. We came off a really rough October through December. And we've had a great start to the year. We're up 17% in the S&P. We've had the best June since 1955 thus far, so we're up about 6.5% just this month.
Wow.
May was a little rough, but we've kind of gotten back on track on that bull market here in June. So, I mean, the Nasdaq's up 20%, Dow Jones is up 14% for the year, and then the S&P is up 17%. So there's not much more you can ask for as far as return.
I know, and a historical average of the S&P would be closer to 9%, right?
Correct, yeah.
So we're basically way ahead of that. If we annualize this return, you're telling me the S&P, and you're not saying this, but the S&P is on track to make over 30% this year. Now, is there something fundamentally, now I know our clients probably aren't looking at their accounts that closely month over month, but what is driving this fundamentally, this big market rally?
So that's a question a lot of people have, even that study the market every day, because it would seem more that the fundamentals are tilted towards this not happening. But we've had, I think the two things that have really been driving it have been the Fed, which we talked about before. They decided to go on pause at the end of December, and that kind of has fed this market rally. And this trade deal, which is kind of being dangled out in front of investors every day. We're 90% there every other day, and that kind of builds on itself and kind of becomes its own self-fulfilling prophecy where the market's going up every day because of that.
Interesting. So let's go back to the Fed here. So the Fed, for the last few years, have been incrementally raising interest rates. And here as of late, they've come out and said, okay, we're going to give pause to that. So why does the market typically like that?
So lower interest rates makes it really easy for companies to fund their debt and to kind of stay relevant. So this becomes a problem for active managers because they're looking at companies that might be economically weaker, but they're not going out of business because of these low interest rates. So
interesting.
Yeah, so accommodative interest rates from the Fed is really good for companies, and that makes the market go up. But typically when we go from tightening rates, raising them, and to lowering them, that's when we would see more getting into a recession.
Right.
But that's not necessarily what happened. That's just historically how that's gone.
Yeah, so a recession definitely could be out there.
It's on the horizon, yes.
What are we thinking? I know nobody knows for sure, but what would be a higher, scenario for a recession? Are we thinking a year, 2 years? I know you can't predict it, but
yeah, I think most people would say 18 months to 2 years.
Okay.
Is around the recession horizon, and it kind of depends on how well the Fed does in timing their rate cuts and how they use the policy that they have. Because if you think about it before, so if we're going back to 2008, we were going from 6.5%, and then the target became like 5.75. Right now we're at 2.5. So it's a much different environment for interest rates than it was in 2008.
So how does this translate? I know this might be a little confusing for clients. So let's talk about just maybe on a simpler level. Mm-hmm. If rates aren't going to, we don't think they're going to rise anymore. Mm-hmm. What does that mean for the everyday person? Like, how is that going to actually impact their lives?
So I think if we're talking investments, I think the bonds is what this impacts the most. So those bonds that have coupons that are over 3%, are going to really appreciate if these interest rates do go down.
Good. So your bond piece of your portfolio should start to rally, which would protect you if we did go into a recession. And then also, I mean, don't typically mortgage rates. So you think mortgage rates will probably stay steady then, and maybe even start to go down?
Yeah, I think they typically follow the interest rate that the Fed sets. So.
And then that also hurts savers, though, right? So people that usually use savings banks or money markets or CDs, those rates will actually start to drift down also. Is that correct?
Yeah, and that's another thing about this interest rate environment that we think about as investors is that savings accounts haven't really been relevant for the past 10 years.
Right.
And now interest rates are going down again. So it's like you might be earning a negative interest rate by keeping your money in savings accounts. So that's a problem for banks, which is why financials have been one of the sectors that have struggled this year.
Yeah, that's a really good point. And what Jesse means by a negative return is that if you factor in inflation, at 1 or 2% or whatever it is, and your money's not making you money in the bank, you're actually losing purchasing power by having your money in the savings and not in a bond or a dividend-paying stock or something that's outpacing inflation. That's good. And so, all right, so what about this China deal? So I didn't realize this, but we're 90% of the way of getting a deal done?
I mean, that's what Secretary of the Treasury Mnuchin said the other day.
Okay.
So that's kind of funny that you mentioned that because that was a headline that came out early in the morning a couple days ago. And it was actually published wrong where it said we're 90% done with the deal. And he actually said we were 90% of the way to a deal before things fell apart. So it got published wrong and futures went up because they thought that they were 90% done with the deal.
Wow.
But in reality, it was just we were 90% done before talks fell apart.
Wow.
So it kind of shows you how sensitive the market is just to these headlines.
Yeah, no, absolutely. Okay, so that's kind of so a lot of it also, I know we've talked about PE expansion. So is that really another reason that this rally has happened? Is it multiples have expanded versus earnings?
Yeah.
Maybe you can explain what PE is a little bit.
So if we're talking about just the rally this year, it's more price has been going up of the stock rather than the earnings of the company. So when we talk about the PE ratio, it's just the price of the stock divided by the earnings per share. And earnings per share has been slowly going down over this year, but price of the stock is going up. So you're paying more per $1 of earnings or 1 cent of earnings for each company.
Does that cause you a little bit of alarm?
It's not alarming, it's interesting, and it's something to be watched, I would say.
Perfect. Is there anything else we missed as far as how we've gotten to here so far halfway through the year that you wanted to talk about?
So one thing that I do want to talk about is the economic data. So I think the one thing that is really driving this rally is consumers. So a report came out today from the Wall Street Journal. The housing spending was up in May 0.4% over what it was in April. And that April number was revised from 0.3 to 0.6, that seems like a small number, but it's actually a big deal because that accounts for 2/3 of the GDP.
Wow.
The consumer spending. So that's kind of what has been really driving the economy for the past couple of months is that consumers are really still pushing and still spending, and that's because wages are increasing, the unemployment rate's down. So I think that consumer piece of the economy is what's been driving a lot of this rally.
Gotcha. So people are making more money. They have jobs, and they're probably seeing their 401k accounts up, so they feel wealthier. Right. So they're buying homes, they're going out to dinner, they're buying goods and services and spending more money. It's driving the economy. Interesting.
Yeah, and I think some of the other economic data that's more leading is ticking downwards, and that's something that would be alarming to investors.
Right.
Not alarming, but it's something to be watched, definitely.
Yeah, exactly. And so the whole idea, the way that we manage money for our clients is that in good years like this, we certainly want to take advantage of it, but we're just being very cautious. So we might be changing the type of stocks that we own. We might definitely are looking at those bonds, and we're all obviously taking an opportunity to rebalance portfolios when it makes sense mathematically.
I think rebalancing is probably the most important thing right now. When I'm rebalancing accounts, I'm selling a lot of stock right now and buying bonds.
Yep.
Because I think it's a good time to do so.
Yeah, that's a prudent thing. So if you're not doing that, or if you're doing it yourself, or your advisor hasn't rebalanced your account in a while, that's definitely something that you should be looking at in there. Very good. Let me see. I'm looking here at my other notes here that we had. So we talked about how the consumer's been driving the market, but do you know some of the best performing sectors year to date? Or maybe you can explain steps, further steps that we're taking with our stock selection.
Your best performing have been technology, real estate, and consumer discretionary. So consumer discretionary is actually one that's kind of interesting because retail has been something that has been under pressure since this China thing has kind of blown up, because that's a lot of retail comes from China. Like if you think Nike, they have multiple manufacturers in China. So that's retail has been under pressure, but consumer discretionary has still been outperforming. IT, especially because of what happened in December, those were the ones that were beat up the most.
Gotcha.
So they came back the best over the course of this year. And then real estate, you think of more as a defensive type of sector that we have seen outperform over the course of the past 6 months. So.
And because we buy individual stocks versus mutual funds or annuities or index funds even, we're able to take advantage and make good selections around these types of sectors that have done well.
Right, yeah.
Right? So what about protecting? So maybe let's go just to this year first. So if we think a recession could happen in 18 months, what are some of the things that you're doing now, or where do you think the market's going to head the next 6 months?
Right. I think, so if we think about what's happened over the past 18 months, we've kind of been trading sideways. We've hit new highs in the S&P, but those are always followed by, drawbacks of 10%, 5%, whatever it may be. So we've been trading sideways for the past 18 months. So I would expect that we would trade sideways. And I don't know how much further the S&P can go, even though we just hit a new high last Thursday.
Right.
I'm not sure. I don't know where that would come from. The Fed and the trade deal, that could help push the S&P past where it is right now. But if those two things don't fall into place how we kind of want them to, then it could be more of a trading sideways or consolidation period for the market.
Perfect. Makes good sense. So again, we just see more volatility, as in moving up and down, and that's what Jesse's getting at by moving sideways. So that's another good reason why we do rebalance. We take advantage of those swings as they happen in either direction, and we are active in our allocation when it makes sense in there. Okay, good. So we talked about where we think things are headed. We're also continuing to sell covered calls. That's another hedge. The idea is that if stocks go down and you sell a call, you collect a premium. Do you want to add anything else, maybe to things that we're doing to protect?
I think rebalancing is something that can't be stressed enough.
Yeah.
Even when stocks outperform as a whole, some stocks within our portfolio perform differently than others. So some will outperform over a period and some will underperform, and then that might switch.
Perfect.
So if you think about a stock like, well, I don't want to go into the individual
we don't
stocks
need
in the portfolio, but yeah.
Well, to protect our clients also, that's why we don't like to talk about direct stocks, because we don't want somebody potentially maybe piggybacking off of us and using that to profit from it. But if you ever do want to talk individual stocks...
Yeah, I'm glad I caught myself.
Yeah, Jesse does that all day long. So he's happy to research something or elaborate on your holdings more specifically in there. Okay, perfect. So what about economic indicators for 2019? So we talked about, we think things are going to go sideways, but are there things that you're looking at specifically to give you some sort of indication of where this thing's headed?
One of the best leading indicators that I follow, a lot of investment managers follow, is the PMIs, which are Purchasing Managers Index. And that kind of shows what purchasing managers, which are the decision makers for companies as far as new orders, how they're feeling about the economy and what their confidence level is. So the readings are, the mid-level reading is 50. So the under 50 is a contraction, over 50 is expansion. So I think that's one of the most important economic indicators that I'm going to be following going forward.
Where are we today, ballpark? Do you know?
It's
just above 50, right?
It's still above 50 for the country. They actually just released the Chicago index today, and it was under 50.
Oh.
So it was like 49.5-ish. I can't remember the exact number, but that's something that we need to be watching, because that kind of gives you an indication of where the economy is headed.
What about individuals? I know a lot of our clients hire us to watch all of this for them, but it's probably going to be hard for the everyday person to track PMI.
Yeah.
Right? So what would you suggest they look at as far as individuals, or what should they be doing to prepare themselves for a sideways market or a recession in a couple of years?
I think a lot of the things that we talked about, trying to make sure that your asset allocation is correct and where you want it to be, that's one of the most important things. If you're out of balance, rebalancing to get back where you want to be. I think that's one of the most important things. Maybe not taking your money out of investments. I wouldn't suggest that as one of the things that you should do, even if you are expecting a recession, because you never know where the market's going to go. Like I said earlier, all economic indicators have been going downwards for the past 6 months, but the market's up 17%. So you never really know where the market's going to go in the short term.
Right, right. That's very good. What about people that are invested in mutual funds or products? What do you say to them?
It's a little more difficult because you don't really know exactly what's in those mutual funds. So it's tougher to say what to do because you can't really do anything.
Right, right. And that's what scares us. And that's why we don't use mutual funds, because the client certainly is not in control of what's going on, nor is the advisor if you're buying them through an advisor, because they're not managing the money either.
You really only have two options. You either stay in the mutual fund or you get out.
Right, right. So again, just be careful if you're invested in products, because not to say that all products are bad, but they don't know the individual themselves. So when Jesse's looking at a portfolio for our clients, he has access to a teammate that can get him the financial plan, or he's talking to the advisor. We're making decisions on a case-by-case basis. And when you're in a product with thousands of other investors, they can't do that. So there is no customization when it comes to your investment portfolio.
Right, and their client really is the fund rather than the people who own the fund. Whereas for us, our client is the person rather than the fund.
Yeah, so just be careful. I would encourage you, if you're watching this and you've got another advisor, ask them, am I invested in products? And maybe ask the question, why? Why aren't you doing it directly? Why aren't you buying the stocks and bonds for me? That's certainly what we do at Falcon Wealth Advisors.
Right.
Perfect. Do you have anything else before we go into the Bird of Prey lightning round?
I think we covered about everything there.
All right, so we're going to do this is a new segment on our show that I started. And basically we've got, it's called the Bird of Prey lightning round, sponsored by Falcon Wealth Advisors. We've got 60 seconds to answer 10 questions, right? So I kind of want Jesse's initial thought, right? There doesn't need to be a lot. We're not going to hold you to this. There's no prize either if you win or lose. But I just wanted to get a little bit more about Jesse to our audience and ask you some fun questions, and some of them are somewhat serious.
Okay, I'm trying not to cheat. I don't want
to. All right, yeah, don't look at my notes here. Okay, so ready? So we'll start to count down now if you're ready.
All right, I'm ready.
Okay. Favorite food?
Pasta.
Best vacation?
London.
Retire when?
As soon as possible.
Okay, good. Bulls or Bears?
Bulls.
All right. Favorite sport?
Soccer.
Okay. Kansas or Missouri?
I have to go Kansas.
Okay. What are the Chiefs' record going to be this year?
That's tough. I think they'll get 11 wins this year.
Okay.
That's my prediction.
All right. Why finance?
It's interesting. Every day is different.
Good. Stocks or bonds?
Stocks.
Stocks. And what's the number one piece of advice you would give somebody? Just general advice.
General advice? Wow, that's tough. I wanted to go straight into finance. I would say live every day like you want to.
Good.
I think
there you go.
Kind of cheesy, but yeah.
You passed. Well, you probably haven't watched the last show, but our last guest said live life to the fullest.
That's a good one.
So you guys are right in line, and you didn't cheat. I don't think you watched the show.
No,
so
I didn't see that.
Perfect. Well, thank you again for participating in our Bird of Prey lightning round. I think it's a fun thing to share with our clients. And I have asked you on previous shows how you first learned about money. Mm-hmm. So we've already covered that with you. But so I did want to ask you one final question here before we run out of time for today's show is if you could go back and give your 12-year-old self advice about finance, what would you tell yourself? So maybe, because you are still a young man, but so something that you've learned over the last decade, maybe that you wish you would have known that you know now.
I think I would tell myself, like, I knew a lot back then, and I know a lot now, but I think I would tell myself to use the knowledge that I had, because I think I had the knowledge and I didn't apply it. I think it's important to be able to have the knowledge that you have, but be able to apply it to real life. I think that's important.
Fantastic. So maybe don't hesitate, right? So if you know and maybe have more confidence and that you are smart.
Yeah.
Interesting.
Use what you know. I think that's important.
That's good advice. And you would tell that to your younger self.
Yes.
Perfect. That's a good observation. Well, thank you as always for the update. I know you're busy in there trading and doing research for our clients. Thanks for taking time today to share some of your knowledge with our audience.
Yeah, thanks for having me on.
Absolutely. And as always, you can please subscribe. This is our YouTube channel, or if you're listening to us on iTunes, please feel free to follow our page. You can also follow us on Facebook, Instagram, Twitter, and LinkedIn. And you can follow me personally on Twitter if you're on there at Jake Falcon CRPC. And Jesse, you prefer email?
Yeah, if you have any questions for me about your individual stocks, if you're a client, Jesse at FalconWealthAdvisors.com.
Thanks again for watching, and we hope you all have a great week.